Hi folks. So today is 16th of January and we have the editorial page of the Economic Times newspaper. Um, so I have identified one of the article which is relevant to the regulatory body preparation. So this is not relevant, same as this one. This is the one which is relevant to the RBI. So let's see. It says interest rate, foreign exchange, keep them apart. So India's growth momentum has eased materially during 2024, and there are plenty of risks in 2025 and beyond. Okay, so real GDP growth should average about 6.5% year on year in financial year 25 and financial year 26, below the potential growth rate of 7 to 7.5%. So it says that what is real GDP? Real GDP is like if we have any base year through which we are comparing what is the GDP growth, right? So that should average about 6.5% year on year basis. And it should also aim to have 7 to 7.5%, but 6.5 is what the percentage below the potential growth rate. However, these estimates are subject to potential revisions when CSO publishes updated growth figures for the past several quarters on February 28, alongside the provisional growth outturn for the October-December 2024 quarter. In financial year 24, real GDP growth was recorded at 8.2% year on year, aided by a subdued deflator. Should FY24 growth outturn be revised downward, it could provide a favorable base effect, boosting FY25 growth projections. Okay, so it just shows that whatever the financial year 2024 growth is, like looking ahead, we can have some growth in financial year 2025 also. So keeping statistical adjustments aside, India's growth trajectory faces challenge that necessitate immediate policy action to mitigate downside risks. The current momentum is not strong enough to sustain robust economic expansion without additional policy support. So the current momentum through which the economy is going through, it is not enough to sustain robust economic expansion without additional policy support. So urban consumption has shown signs of fatigue with the exhaustion of pent-up demand, while rural development, despite gradual improvement, remains inadequate to offset urban drags. So urban consumption, it is showing a sign of fatigue, and with the exhaustion of pent-up demand, the rural consumption, though it is improving, but it is inadequate to offset urban drags. GST collections in December grew by 7.3% year on year, marking the fourth consecutive month of single-digit growth. Manufacturing PMI for December stood at 56.4, the lowest in 12 months, and the core infra production growth, while slightly improving to 4.3% year on year in November from 3.7% in October, remained below the 5% mark. So the Bloomberg consensus estimate for financial year 25 growth stands at 6.4%, slightly lower than Deutsche Bank's projection of 6.5%, and RBI's projection is 6.6. For financial year 26, the consensus aligns with DB's estimate of 6.5% year on year, while RBI projects a marginally higher growth of 6.7%. On inflation, RBI's forecast of for financial year 26 consumer price index stands at 33.8% compared to Deutsche Bank's and consensus estimates of 4.3%. So RBI forecasts inflation to average 3.7 to 3.4% and 3.5% across July, September, October, December, and January, March quarters of financial year 26, respectively. Okay, so addressing these economic challenges, these are basically the data. What is the forecast of different banks? So the Bloomberg consensus, it shows this. The Deutsche Bank's projection has shown this GDP growth. Okay, and it also shows the signs of inflation. Similarly, for RBI, it shows the growth of GDP at 6.6%, and CPI stands at 3.8% for financial year 26. Okay, so addressing these economic challenges required a balanced mix of monetary and fiscal policy interventions. So both RBI and the central government should have intervention on these policies Fiscal policy is expected to remain on a consolidation path, with Government of India likely to reduce the financial year 26 fiscal deficit to 4.5% of GDP, down from the budgeted 4.9% in financial year 25. So fiscal deficit, so what is a revenue which is coming and then the what expenditure, right? So that is the fiscal deficit excluding borrowing. So total number of uh, uh, this one savings. Okay, I mean we can just say that what is the tax coming, the receipts of the government and the expenditure. So when the expenditure is arising compared to the receipts, so that means there is a deficit in the fiscal policy. And when we exclude the borrowings taken by other banks or other institutions by the government of India, then it shows, I mean, that also marks fiscal deficit. So it is down from the budgeted 4.9. So in financial year 2025, we have projected fiscal deficit of 4.9%, but it will go down below 4.5% in financial year 26. Okay, so meanwhile, monetary policy must adopt a forward-looking approach given the lagged impact of interest rate changes on the real economy. So with the US Fed having cut rates by 100 basis points in 2024, there is room for RBI to ease rates by 50 basis points. So Deutsche Bank forecasts 25 basis point repo rate cut in February 2025, followed by another 25 basis points in April to minimize growth sacrifice and prevent falling behind the curve. So this is how we are uh, uh, like estimating or maybe anticipating how we can do minimum growth sacrifices but still be ahead in the curve or be or maintain that growth curve. So it says that if we cut down the repo rate, okay, so what it will happen, uh, it will basically allow the flow of money to happen, right? So like if we have less repo rate, for example, so there will be a large amount of money that will be having with the bank. And if the bank has more money, it will try to lend out. So there will be loans. So we will be able to buy more. So the purchasing power of the people will be more. This is how it tells about the current January to March 25 quarter. Okay, now complementary liquidity easing measures. Historically, RBI has waited a maximum of 11 months between the end of a rate hike cycle and the start of a rate cut cycle. But this gap now extended to nearly 2 years because the rate was same, underscoring the urgency for action. In addition to rate cuts, liquidity easing measures will be critical to support economic activity. Currency leakage during the Jan to March 2025 quarter is expected to reach 1.5 rupees trillion, and ongoing forex interventions could further tighten domestic liquidity. While RBI's 50 basis points CRR cut in December 2024 was a timely move, it may prove insufficient for 2025. So what it did to fight this inflation or to fight the current economic situation going on in the economy, RBI had cut down 50 basis points in CRR. So before it was 4.5%, now it is 4%. So complementary liquidity easing measures such as enhanced quantum of variable rate repo auctions, long-term forex swaps, and potential open market operations will likely be required to achieve an effective transmission of policy rate cuts. These actions could drive short-term rates in the future closer to the standard deposit facility rate, effectively resulting in a 75 basis point easing during this cycle. Okay, so it tells about the different tools of the RBI's, which it uses: the repo rate auction, long-term forex swaps, open market operations in which we sell the government securities, right? Then uh, also it tells about the standing deposit facility, how it will automatically move. It is the lowest in, I mean, it is the lowest point in the corridor, right? In the moving corridor in between the repo rate and the marginal standing facility. Okay. The rupee should depreciate to 87 rupees against the dollar by March 2026, with potential for an earlier decline if global trade tensions escalate or RBI relaxes its foreign intervention strategy, notably refraining from the rate cuts The rate cuts will not shield the rupee from depreciation if broad strength sustains, but may increase downside risks to growth. So it's essential to decouple interest rate policy from forex policy and perhaps allow the rupee to exhibit a greater two-way movement. So it tells that the rupee should depreciate to 87 rupees by the end of March 2026, and RBI should relax its foreign intervention strategy if it wants to decline the global tension which is arising. Now, while current account deficit remains manageable at 1.5% of GDP, volatility of capital flows, exacerbated by strengthening dollar index, poses a risk to the rupee. The dollar is strengthening, that's why. Addressing these challenges require a proactive policy stance to balance growth and macro financial stability in a complex economic environment. So, this is what it tells, that this challenge all requires a proactive policy to sustain and uh, make the system stable in the complex economic environment. So India stands at a critical juncture where decisive and timely policy measures can revitalize growth momentum. By combining monetary easing with liquidity enhancing initiatives and maintaining fiscal discipline, India can mitigate risk and set the stage for sustained high economic growth. So this is the editorial by one of the economists at Deutsche Bank. That is all for this. Thank you for connecting.